seem a little bit as an aberration when compared to quarter 2, quarter 3, but it's in line with how we planned the year. There's nothing in this quarter that we think that we need to be alarmed about. So just going through the results, quarter 4 we are showing a 5% growth in sales adjusted for GST. We're showing a 10% improvement in EBITDA. We're showing a PAT improvement of 6%, and there are some exceptional items that Kedar will talk about in the presentation. So altogether, we had predicted that this year would be somewhere between 16 to 18% on EBITDA. The year's ending up at about 18.6%. So it's ahead of our guidance range. Our revenues are up 6% adjusted for GST, and profit after tax is up 40%. So I think we've had a great year. Most of our key markets have shown great growth. India has shown a growth in the quarter of about 21%, in the year of about 11% adjusted for GST. US is showing growth. Our launches are coming through. We're hoping that the launch trajectory would build up in the years ahead, in the months and the quarters ahead, as well as the years ahead. Of course, this quarter we wanted to show a little bit more. We're a little short. That's because of certain supply issues that we had in regards to our plants in North America. South Africa continues its golden run. I think we're beginning to see great growth from the market there, and it's continued. So we've got limited competition products launching in the US. We're stepping up investments in R&D, and key markets are on track. So that's a snapshot of our year performance and the quarterly performance. I'll now request Kedar to go through some of the slides on each of the markets and the financial performance, and I'll come back right at the end to talk to you about what goals we have for the year ahead.
Thank you, Umang. So we ended the year with very strong note. Umang alluded to these numbers. We have grown our revenues from operations by 4%. This is reported. Adjusted for GST, this is 5%. Our EBITDA for the full year is 18.6. This is higher than the higher end of the range that we had set for ourselves. Our EBITDA in absolute terms increased YOY by 14.2%. So you can see that the growth in EBITDA is higher than the growth in revenues, which means margins have expanded and operating leverage has got played out. Our profit after tax has grown up by 40%, compared to last full year. PAT is now at 9.3%. So very strong story on margin expansion, very strong story on cost control, very strong story on product mix improvement. Revenue breakup you can see on this slide. India, our home market, is at 40%. North America is 17%. SAGA, which is the region that we formed, which includes South Africa, Sub-Saharan Africa, and the global access business, is 22%. Emerging markets is at 11%. So it is fairly well diversified global footprint. Coming to quarter 4, we grew our revenues by 3%. EBITDA has gone up by 10%. So again, I think the margin expansion and operating leverage is reflected in the P&L. PAT is 4.8% to revenue. That includes 2-3 adjustments related to exceptional provision on account of DPCO overcharging liability, a little bit of a loss on account of the disposal of our Yemeni subsidiary, and certain one-time costs in sales and distribution. If you adjust those three, the PAT for the quarter is quite healthy at about 7.6%. This slide refers to cash flow generation. There are 3 metrics: net debt metric, which is a metric of financial leverage; net debt to equity is again normalized measure of financial leverage; and net debt to EBITDA is indicating the debt service capacity.